If you look at India's retail sector right now, one player is moving with the momentum of a runaway freight train. Reliance Retail's Q4 revenue shows an 11% jump, reaching 87,344 crore rupees in a single quarter. But right next to it, this tiny sliver is their net profit. While revenue soared, profit barely moved, creeping up just 0.5% to 3,563 crore. Looking at the gap between those record-breaking sales and the thin earnings, we are seeing a deliberate choice. Leadership is actively trading short-term margin for long-term territory. So why is the largest retailer in India intentionally keeping its own short-term profitability in check? The answer starts in the physical aisles. Expanding their real estate territory across the country and building out that much physical space drains capital fast. This map tracks their rollout speed. In just one quarter, they added 1,564 entirely new store locations. That brings their total footprint to 20,160 stores, covering over 78 million square feet of operated retail area. The expansion worked as intended. By pushing their physical boundaries, they grew their registered customer base by 11%, reaching 387 million people. But locking down prime real estate, building infrastructure, and running targeted festive promotions to draw those crowds requires an immense amount of cash up front. To see the impact of that spending, we have to look at their EBITDA margin, the metric used to measure operating profitability before taxes and interest are factored in. This graph tracks their EBITDA margin over time. Because of the sheer cost of this expansion, you can see the margin soften here, dropping by 60 basis points down to 7.9%. Every decimal point of profit sacrificed on the balance sheet is being converted into permanent physical dominance on the ground. Beyond the physical stores, capital is being diverted into the faster, more aggressive fight for hyperlocal digital commerce. Year over year, the sheer volume of rapid digital transactions flowing through their systems grew more than fourfold. Servicing that volume requires a massive logistics network. They are now running a delivery system powered by over 3,100 stores, spread across 1,200 cities. The digital push is capturing serious territory. Their JioMart platform alone acquired 5.8 million new customers in the fourth quarter. Yet acquiring millions of users in the quick commerce space means spending heavily on warehouse logistics, paying for driver incentives, and deep promotional discounts. Winning the hyper-local delivery war is a mandatory survival tactic. Outspending the competition to secure those users justifies the squeeze on their quarterly bottom line. If we step back from the quarterly earnings report, the executive leadership at Reliance has a much longer timeline in mind. They view this year's spending as a deliberate structural strategy. The goal is to build a platform tailored to the Indian market, backed by an overwhelming advantage in scale. As they enter the 2027 fiscal year, their operational phase is shifting. They plan to take that nationwide reach and start extracting deeper, monetizable value from every transaction. To do this, they are leaning on specific technological tools, like embedding AI directly into their merchandising processes and implementing data-driven pricing models. Reliance Retail is not optimizing for a tiny profit bump today. They are intentionally trading margins right now to construct an inescapable commercial ecosystem, setting themselves up for a decade of market control.